Hello. Today we're going to talk about a number of things related to credit. The first thing that we will address is the difference between secured and unsecured debt, and then talk about what collateral is. Then we'll talk a little bit about down payments as they relate to home purchases and mortgages, and what it might be like to apply for a mortgage, and whether home owning is necessary nowadays to achieve the American dream. And then finally, we will address what happens when you get in trouble with your credit and you need to seek counseling, or if you run into situations that are biased or discriminatory, what does a borrower have in terms of protection when it comes to being a consumer? So I'm going to share my screen with you. So I call this presentation Credit and Its Risks. So the first thing that we want the kids to be familiar with and comfortable with is this idea between secured and unsecured loans. Since throughout their lives, they will be, of course, applying for and hopefully acquiring both types of loans. The graphic that I show you here is an illustration of rejection rates. And this is going to illustrate the difference between secured and unsecured loans. On the left-hand side, we see bar graphs related to credit cards and card limit increases. And you see that there is a much higher rejection rate, something close to even 40% when it comes to credit card limits. And then to the right, we have mortgages and auto loans. And you can see that there is a far smaller number of rejections. So more and more people do acquire these loans than the other two. And so we have to pose the question, why? Why is this the case? All right, so the loans that have the lowest rejection rate, this might be a question that we would want the kids to be able to answer. Why do you think this is the case? So credit cards and the amount of money that you can borrow on the card seem to have the highest rejection rates. And that is because they are unsecured loans, and meaning that there is nothing but the faith that the lender has in the borrower to support this loan. There's no collateral, there's no asset set aside at all. You can make the analogy, for instance, if I lend you, as a student, if I lend you money to buy lunch, then you give me your pencil, that represents collateral. And the moment that you pay me back, I will give you back your pencil. But when you are, in this case, it is purely the faith that you have in the ability of the borrower to repay. So you can see that there are a number of people, especially when it comes to asking for an increase in the amount that they can borrow on their credit card. You can see that there are a number of people that the lender just doesn't really trust or doesn't believe has the ability to repay or the ability to handle a higher balance on their credit card. So that would be the reason why there's a high rejection rate, okay, versus the lowest rejection rates, okay, which we see are for mortgages and for auto loans. And in this case, a mortgage, of course, is a loan when you buy a house. And an auto loan, of course, is a car loan. And in both cases, until you repay the loan, the bank essentially owns the house. They have the title to the house, they have the title to the car. So they have a fallback, they have collateral, they have something that they can recoup a loss if the individual doesn't pay. So that gives them a greater sense of security. That indicates, of course, that there's less risk that a person's not going to repay their home loan or their auto loan. So that is going to give them a greater desire to lend this money. So you can see that by all means, there is a lower rejection rate for these, and then a higher rejection rate for things that do not have collateral. So the key here, it seems, is the existence of or the lack of collateral. Okay, and credit cards initially come, and quite often credit cards will come with a low credit limit. So there's a level of comfort that the lender has. And so as you can see, there's a relatively modest rejection rate for that first initial credit card limit. But once someone begins to ask for higher ones and higher ones, then it makes the lender suspicious that maybe the individual is too dependent upon credit. So that is going to make them much more scrutiny when it comes to reviewing these applications and approving these applications. So a secured loan would be a loan that is backed by an asset, like a house, a car. Okay, so we indicated earlier that a mortgage is a secured loan because the bank owns your home until you repay the mortgage. So the agreement, of course, is that if you fail to repay, then the bank or the lender has the ability to repossess the collateral and use that to secure their investment. Unsecured loans, on the other hand, do not have any asset whatsoever tied to them. So credit cards and student loans are examples. A credit card, of course, is an instantaneous access to credit. When you put a credit card down on the counter at a store, you don't have to also push forward to the cashier some asset that they're going to hold until you repay. And the same thing is true with student loans. I mean, student loan is something that you use to get an education. An education is not a tangible item that can be held aside until the loan is repaid. So in both cases, there's no asset the lender can take if you fail to repay your loans. So the lender is lending to you in good faith, with the expectation of being repaid, but really having nothing to fall back on in terms of security. So here's a variety of loans, okay? And we see everything from personal loans and payday loans and credit cards from stores that have really high interest rates to more modest interest rates in relationship to a mortgage, an auto loan, a small business loan, a student loan. All of them have comparatively modest interest rates. So why do the interest rates vary so widely? Well, we want the kids to understand that this is based on risk. If I feel like I'm taking a risk, then I am going to expect a bigger return for the risk. So we learned earlier that the most risky form of debt is unsecured debt, because there is no asset, there is no title that you're holding on to that can be used as recourse. So what this chart is indicating, and you can see at the bottom that these percentage rates are based on a fairly decent credit rating. That's about the average credit score. The average credit score is a little over 700 in America today. So that falls kind of right on the average. So these would be the interest rates that the average borrower in America would receive. So the difference here must have something to do with the level of security, the level of risk, and therefore we're going to assume that it has something to do with collateral, the existence of collateral. Okay. So there is if the risk is high, the interest rate's high. So there's a direct relationship between those two. Now, a student loan, as I indicated in my previous remarks, I kind of jumped ahead. A student loan, of course, is something that is unsecured. But there is a significant difference here because most student loans are insured by the federal government. They are backed by the federal government. So a lender knows that if they lend money to a person who wants to get a college education and that individual defaults on that loan, then in a federally backed student loan, the federal government will step up and repay the lender and then address the borrower themselves. So one of the unusual features of a student loan that's not the case of any of the other ones that you see here, the types of loans here, is that most college loans are federally backed, okay, federally secured. So the federal government has the back of the lender. And so that gives them a security enough to offer a lower interest rate. Payday, on the other hand, you can see a 391%. A payday loan is oftentimes acquired by people that really have no other recourse. In other words, they don't have access to mainstream credit. Okay, they don't have a credit card. They don't have a. They can't access a bank loan. So but they need to borrow money, and typically that money is necessary, although unfortunately not always. But sometimes that money is necessary for an emergency, like you've got medical emergency, you got to pay a hospital bill or emergency room bill. You've got a car that needs repaired, but you don't have the money. So a payday lender is somebody who is willing to lend money to you, okay? But they expect the money to be repaid within 2 weeks. 2 weeks is the typical amount of time from paycheck to paycheck. So that's why they call them payday loans. So these are highly, sketchy, and but oftentimes they are the only avenue of recourse that a borrower has. So and in a recent year, I remember a data piece that I looked at. Something like 12 million Americans access payday loans, and payday loans, of course, can come in the form of from a pawn shop. They can go to like a rent-a-center type of thing. There's a variety of different ways in which you can get a loan from a non-mainstream lender. All right, from here, let's talk a little bit about the method of the loan, the method of repayment, and the method of credit that's available to the individual. You've got a variety of different types of credit: revolving, installment, non-installment, which is generally service credit. When you are acquiring utility services or cable services or your cell phone services. And some of them are secured and some of them are unsecured. So revolving credit, this is what a credit card is. It's a revolving credit account. It's open-ended, which means that the loan never ends until you cancel the card. Okay, it is continuously replenished. Okay, it can be secured. I mean, there are some credit cards that do require some type of asset for very highly risky borrowers. Okay, but generally most of the revolving credit is unsecured. You can borrow at any moment. There is a set limit. We talked earlier about this idea of a credit limit that you are tied to. You are offered flexible payments, which means that you may have to meet a minimum payment, but you don't have to pay it off all at one time. Okay, and you don't by any means have to pay off your balance, within a particular period of time, but you do have to meet minimum payments. Usually, the minimum payment is based on the percentage rate that you're paying on the balance that's due. There are finance charges that are accrued if you do not pay off your balance. But once you do pay off your balance, the full amount of credit is replenished. Okay, the full amount of credit is given back to you to reuse again. So generally, again, a credit card is the most common example of this. And if I have a $10,000 credit limit and I use some of it, okay, all of a sudden the amount of credit I have available to me is reduced by the amount that I've used. But once I repay what I've used, then that limit is replenished to its full $10,000. Then we have installments, and these are the types of loans in which you pay back generally the same amount of money incrementally, more often than not, month after month after month after month. They tend to be secured. Because, as you can see at the bottom, home mortgages, car loans are examples, but they can be unsecured, as we've learned. Also, a student loan does not have collateral tied to it. Okay, you know exactly what your responsibility is if you have a fixed rate loan, okay? And you know how many months you will have to pay. And then once you have met your obligation, the loan goes away. So there is a term, there is an amount, there is an incremental amount that you have to pay, okay? And that's a fixed number of payments. And once that time period is up, once you've repaid, then the house is completely yours. You have full equity in the house, full equity in the car. Okay, you're no longer obligated to the student lender. So these are also very familiar to people. Installment versus revolving. Now, service credit, again, is when you are applying for utilities, typically. Utilities such as the electric, your electric bill, cable, or cell phone. They are unsecured because, I guess, except for the fact that they could turn your service off if you fail to pay. Okay, but it is something that you have to apply for, because like everybody else in this scenario, in all the scenarios we've been talking about, there is an expectation of repayment. So if I am moving into my first apartment and I want FP&L to turn on the electricity, they're going to take a look at the level of risk that I present. They want to know what my credit score is. They want to know if I've been a good borrower. Okay, if I have been a good borrower, then they will pretty much freely turn my electricity on without really obliging me to anything beyond the good faith that I will repay my bill. And every month I'll pay my bill. And since I've proven that I've done that in the past, then that's exactly what they will expect me to do in the future. But let's say that I have a low credit score. Let's say that I have a history of not necessarily being the most responsible borrower. FP&L might ask me to put money up front, to put money in escrow, so to speak. So out of concern that maybe I won't meet my obligation because I've proven difficulty in doing that in the past. Same thing might be true for the cell phone, for the cable company. If you have a low credit score, if you have a history of not necessarily meeting your obligations all the time, there may be an expectation of additional funds put in escrow just in case you are unable to pay back or meet your obligation and continue to pay your service. So, we're not going to address credit scores, but obviously this is a reason, another one of many, many reasons to maintain your credit score, to have a high credit score. Because you may have, you may get an apartment, but have a really hard time affording the utilities. Okay, or you have a need for a cell phone, but you may have a real hard time meeting the obligations if the cell phone company asks for money up front. So this is a form of credit, though, and failure to pay your utility bills, failure to pay your cell phone bill, will go on your credit score and will depress your credit score. Okay. Now, when we borrow, we of course are seeking a certain amount of money. We know what the house is, what the price tag of the house is. We know what the price tag of the car is. So we are seeking a certain amount of money to borrow. One of my options, of course, is that I can use some of my own money, some of the money that I have out of my own resources to pay forward towards this house or car, and therefore reduce the amount that I have to borrow. Okay, so that is called a down payment. A down payment is the cash you pay, okay, out of your own pocket that is not borrowed money. And so it represents equity, immediate ownership in the assets. Okay, and it can be an upfront payment when you're buying a house or a car. So the greater the down payment, the less that I have to borrow. So here's a scenario. Let's say that I'm buying a house. There are mortgages, okay? Mortgages, of course, represent the home loan, and there are mortgages that you can take out with a bank, and the bank really likes to see a higher down payment. So 20%, if I'm buying, think about that, that's a significant amount of money. Okay, homes in South Florida right now are going for hundreds and hundreds of thousands of dollars. So 20% represents $20,000 on every $100,000 of home price. So that can be a big nut for somebody to pull together, and could really keep them from buying a house. So there have been at times especially in the previous decade, at times where banks are willing to lend money with a relatively small down payment. So 3%, think about that, that's only $3,000 for every $100,000. So that could be a much more accessible number for borrowers. So let's talk about, what are some of the advantages? If I put the 20% down, okay, I'm going to get a better interest rate because the lender says, wow, this guy has put down 20% of the price of this house. He's got a big stake in this house. He already has significant equity. Okay, the 20% that I put down represents that I own 20% of that house. I have equity in 20% of that house. So I'm not going to walk away from that. My monthly payments are going to be smaller because I am borrowing less. Typically, a mortgage is a 30-year mortgage. So you would take the amount borrowed and, of course, and add the interest rate, and then you would divide that by 360 months if you're paying a 30 years. So if I'm borrowing less, my payments are going to be smaller. As I said, I have instant equity, instant ownership that I can, and without getting too complicated, can actually borrow against in the future if necessary. And private mortgage insurance is, again, something that a lender will charge. It'll be an additional fee. It'll add to the monthly cost of your mortgage as a protection to the lender if somebody has less than 20% equity. In other words, they have less than a 20% stake. So if you, most banks nowadays, if you put 20% down, you avoid having to pay that additional fee of insurance that the lender is taking out against you in order to, in case you don't repay your loan. Now, on the other hand, a 3% down payment, you have additional closing costs are paid up front as well. Okay, you don't drain your emergency savings. One of the basic rules of personal finance is that you maintain an emergency savings fund. Having to come up with 20% all of a sudden can be a real challenge and can drain your emergency savings and put you into jeopardy if all of a sudden the unforeseen happens. Okay, it's much easier for a first-time homeowner to get together 3% versus 20%. And in the future, you can refinance your loan after a few years. You can refinance your loan for better terms if the interest, because interest rate is going to be higher at this rate. But then if you prove over time that you have been a good borrower, that you've repaid regularly, then you can refinance. You can refinance. All right, so this idea of home ownership. I mean, there was a time in history when it was a no-brainer, when it was an obvious thing. I mean, mom, apple pie, baseball, and home ownership. That was what America was all about. But then about 12 years ago, we had the housing crisis. We had the collapse of the economy. We had a lot of people buying homes and getting burned on their home ownership and having to walk away, having their financial lives ruined because of home ownership. And in the aftermath of that, there has been a little bit of reflection in terms of whether home ownership is that no-brainer? Is it something that we necessarily have to do in our adult lives? Okay, so it is, again, the American dream: white picket fence, 2.5 kids, couple cars, and a home, right? But that dream again has struggled in recent times, and we're going to listen to this video real quick here, and for a different perspective.
This summer, get away from it all with the new comedy drama series Us on Masterpiece. Let's make it a rule. Live in the moment. The 10th annual PBS Short Film Festival. We should not let go of our roots.
Sorry for the commercial.
Icon, music through the lens. Cover Rolling Stone, Nephew or something. An expedition with Steve Backshall unpacked. It is a once-in-a-lifetime thing. It's awe-inspiring. All this and more, only on PBS and the PBS Video app.
When you hear the phrase the American dream, what picture comes to mind? For a long time, the classic version included a white picket fence, 2.5 children, and of course, a house.
The importance of home ownership is still embedded in American culture. 7 in 10 adults say they want want to own their own home someday, and yet actual home ownership has dropped to its lowest level since 1967. The biggest culprit, those pesky millennials, with an 18% decrease since 2004.
If owning a house is still important, then are young people just being foolish, or are they reacting rationally to a changing economy?
In theory, owning a home still makes a lot of sense because it kills two financial birds with one stone. It's a place to live and a long-term investment. Every time you make a mortgage payment or the value of your home increases, you're saving money for your future self. It's like a piggy bank you can sleep in. But the world is changing in ways that make this scenario harder to pull off.
Younger people have more debt than previous generations, mainly thanks to student loans. The average amount that a graduate owes has tripled in the last 25 years, which means that many young people already have a house-sized debt cloud hanging over them without even having an asset to sell.
As if that wasn't bad enough, millennials have a larger burden for retirement. In ye olden days, the average American could expect 3 sources of income to support them in their autumn years: a pension, Social Security, and personal retirement savings. But thanks to shifting labor trends and shrinking unions, pensions are quickly becoming a thing of the past, and it's giving this 3-legged stool a major wobble. And since we can't expect Social Security payments to substantially increase anytime soon, younger people will be expected to make up the difference with larger retirement savings, which means less cash on hand to put towards a house.
The shifting labor market has also led to more pressure to be geographically flexible instead of being tied down to one location. And the importance of travel for young people is at an all-time high. In the US, millennials rank travel as more important than homeownership and report they're more likely to set aside money for that rather than buying a home.
Considering these factors, it's no wonder millennials are viewing homeownership as more of an option than a necessity. So, is it an option that's right for you? Here are some questions to ask yourself.
1, can I get good mortgage terms? Unless you've got hundreds of thousands of dollars sitting around in cash, you're going to have to borrow the money and pay for the privilege. How much you'll pay in interest is determined by a number of factors, but generally speaking, in order to qualify for terms that make home buying a good investment, you'll need a consistent, provable source of income, a credit score of 760 or higher, and a down payment at or close to 20% of the home price. If you can't meet these requirements, it might not be the right time to buy a home.
2, will I have emergency money left over? The money you have wrapped up in your house isn't liquid, meaning you wouldn't be able to get to it easily if you need it. So if your AC breaks down or your car needs repairs and you don't have any emergency funds set aside, the only thing you'll have to cling to is debt, which is more of a lead weight than a life vest. So be sure you have at least 3 times your monthly expenses left over after your down payment.
3, can I stick around for at least 5 years? Buying a house that you have to sell again quickly probably won't end well. You have to consider upfront costs like realtors and inspections. Plus, at the beginning of your mortgage, most of your monthly payment is going towards interest, meaning your debt isn't actually shrinking that much. For many buyers, it can be a decade or more before that ratio is even 50-50.
So how do these factors shake out in a real world example?
Let's
Run the numbers. This is Ramon. Ramon has a good, steady job. He's been saving money, and he's thinking about buying a house for around $200,000. He only has enough for a 15% down payment and no emergency fund.
Also, there's a chance Ramon might decide to relocate to New York with his girlfriend when she graduates from law school in 3 years. By that time, Ramon will have only paid off around $9,000 of the loan principal. So if the home value increases by an average of 5%, he'll be able to sell it for a bit more than he bought it for. But that's not counting the realtor fees, property taxes, and upkeep.
If everything goes perfectly smoothly, Ramon will just break even. But if just one thing goes wrong, like losing a job for 6 months, or he has to replace his home's roof or AC, it's a different picture. Ramon might want to hold off on buying a house for now.
If you're like Ramon, don't freak out. You could never buy a home, but still be okay financially. There are even some perks like not being responsible for maintenance costs and being able to easily pack up and move if you get a better job opportunity.
But investing is like exercise. Some workouts deliver better results than others, but anything is better than doing nothing. So if you're not going to buy a house, it's extra important that you're making investments in other areas like a 401k or a company that you own.
There's no sugarcoating it. When it comes to home buying, millennials got a tough deal. But you can overcome that disadvantage by understanding your situation and starting to plan for it now.
And that's our 2 cents.
All right, so that's an interesting perspective. Many people, obviously from my generation, were completely committed to the idea of owning homes, and for the most part, it was advantageous. But times are different now. Times are definitely different. All right, so for the remainder of this presentation, we're going to talk a little bit about the idea of what can consumers do when they have difficulty repaying their debts? You know, where can they seek assistance? And what are some laws that protect people from felonious lenders, people that are going to take advantage of you or exploit a certain situation? So there are 3 pieces of federal legislation that lenders should be familiar with. Okay, they all fall under the umbrella of the Consumer Credit and Protection Act. So there's the Fair Credit Reporting Act, the Truth in Lending Act, and Equal Credit and Opportunity Act. So in the Fair Credit Reporting Act, it regulates how your personal information is used by a private business. Okay, everybody likes that. We're all about protecting our identities now, and we hate to have our information floating out there, you know, in unknown waters. It gives you the right to a free credit report annually. Okay, every person can access credit reports from the 3 credit report agencies. So that means you can get one from each of the 3 credit reporting agencies annually without any cost. It's suggested that you spread them out over the year because they generally say approximately the same thing. They you would like to see how your credit is changing quarterly as opposed to just once annually. Okay, and without a doubt, you want to make sure that there aren't any mistakes. Okay? There have been reports in recent years that as many as 40 million Americans have some type of mistake on their credit report, and those mistakes can cost you money. Those mistakes, you know, in the extreme, can get access to credit denied to you. So you want to definitely do that. And then it gives you the right to have those inaccuracies fixed in a timely manner. So you know, you have recourse, you have the ways to pursue if you believe that the credit reporting agency has made an error. Truth in Lending provides consumers with relief from unfair billing practices and deceptive advertising, right? So the bait and switch, the idea of going into a retail situation and being told one thing, and then all of a sudden you see the fine print on a credit application tells you something else, okay, and you are being exploited. This is something, unfortunately, that happens way too often. So you have protection from that. Lenders are forced to provide all information up front so that there can be comparisons made when shopping for loans. And you have the right of rescission, which means that you have like a grace period where you can change your mind within 3 days, okay, and reconsider a loan or move on from it. And then the Equal Credit Opportunity Act has to do with you know, any form of discrimination. Okay, unfortunately, there has been a long history in this country of lenders discriminating against people that they perceive to be risky. Okay, the idea of redlining, okay, where African Americans were denied access to credit because of where they lived, and the assumption that their credit behaviors were more risky than non-African Americans, and so for way too long, they were denied access to credit, which denied them the ability to build wealth, to purchase real estate, to start businesses. And that has translated to this huge wealth inequity that exists today. So Equal Credit Opportunity Act is the 3rd piece of this shield to protect you from unfair credit practices. All right, so when we talk about 4 mistakes that can get you into debt, okay, you can see that That gray line on the graph represents the Great Recession that occurred in the previous decade. And this, of course, as you know, was fueled primarily by people borrowing recklessly, by banks lending money recklessly, by conditions of loans being untenable. And that led to a huge amount of debt. And then everybody began to bail on their homes and they began to default on their mortgages. And so the level of debt and credit card and revolving debt and so forth plummeted as people began to lose their jobs. People began obviously to consume less. But it's been rebuilding ever since, and it is moving now. Actually, if we extrapolate this out to the current times, the credit card and revolving debt that exists today in 2021 is in excess of where it was in 2008. So that may be something to be concerned with. So what are 4 mistakes that can get you into debt? Collecting credit cards. You have probably been in a situation where you've walked into a retail store, you're checking out, and all of a sudden the cashier says, well, you know, if you fill out this form and apply for our credit card, you can save 20% today. And a lot of people do that, okay? But then all of a sudden you begin to collect credit cards with a lot of open credit. This is a temptation that people unfortunately will utilize recklessly. And so you collect a lot of credit cards, it just opens the door to a lot of potential borrowing. Not having enough savings, okay? We've already discussed, alluded a few times in this presentation to the idea of maintaining an emergency fund. Okay, having some money to fall back on. If I have no emergency fund and the inevitable, unexpected thing occurs, you know, where am I going to get the money to borrow? I'm going to have to borrow. I'm going to have to go into debt to fix my car, go into debt to pay that medical bill. This idea of keeping up with the Joneses, right? The Joneses are this fictitious group of people that always seem to have new stuff, always seem, you know, they live a lifestyle that seems just a tad out of the reach of their neighbors, of individuals around them. But because of the pressure to maintain appearances, people will borrow the money and buy their lifestyle anyway. So keeping up with the Joneses and this sense of kind of a consumer merry-go-round or a treadmill, okay, in which you are continuously trying to achieve a lifestyle and you can never achieve it, but you always are motivated to go for it. This can create a great amount of debt. And then, of course, failing to budget. I mean, budgeting is simple. The idea that you want to know how much money is coming in, you want to know how much money is going out. Okay, and if you fail to keep a record, if you fail to be conscious of your purchases, all of a sudden those small purchases and those small uses of your credit card can balloon. So let's listen to this piece here on why Americans don't save anymore.
Here's a stat that you might relate to. Americans save, on average, less than 5% of their income, according to the Bureau of Economic Analysis. For comfortable retirement, financial planners say we should be socking away more like 10 or 15% of our paychecks. Hasn't always been like this. We haven't always been bad savers. Derek Thompson is senior editor at The Atlantic, and he joins us as he does each Monday from New York. Derek, welcome back.
Hey, good to be here.
So you've just written about this, and you say this is a myth that Americans can't save.
It is a myth that Americans are incapable of saving as a country. You look back just a few decades ago, and the bottom 90% of households saved 10% of their income in just the first Reagan administration. So in 30 years, we went from saving 10% of our income to 2006, when we were saving negative 10% of our income. This was at the height of the housing bubble, when a lot of people were socking away their savings in their homes, getting enormous mortgages. And so I really wanted to look at this question, all right, why do Americans save so little compared to other countries, other rich countries like Canada, Germany, Japan? They all seem to save rather successfully. And why don't we even save as much as we did 30 years ago? That was the big mystery to me.
I want to throw out another statistic here because they're fascinating. You say that nearly half of all Americans, and this is according to the Federal Reserve, could come up with $400 to pay for an emergency. This is a very big deal. If your car breaks down, you can't afford to fix it, you can't get to work. So just go through some of the theories that you have about what's going on here.
Sure. I first of all wanted to know This phenomenon isn't, well, it is new. It started rather recently in the last 30 years. And America's poor middle class are especially ill prepared for retirement compared to other rich countries. So I had to look for explanations that were both recent and where America was different from the rest of the world. So first theory is that Americans stopped saving when income stopped growing. Between 1960 and 1973, per capita income was growing at a really healthy annual rate, over 3%. In the 2 decades after that, its growth rate fell by half. So it's possible that one thing that we're seeing is that middle class stagnation has led to a collapse in savings. People have less money, and so they save less money. That makes sense. But this collapse in income growth happened around the world. So why is the US exceptional? And one of the most interesting theories that I came across here is about the intersection in the US specifically about income inequality and the lack of saving. And there's this theory from economists called trickle down consumption. That is, households exposed to richer households essentially try to emulate those households. They try to keep up with Joneses that are way outside of their income bracket. And as a result, this conspicuous wealth, spending on luxury, becomes sort of contagious. It spreads like a disease from the rich who can afford this lifestyle to the upper middle class, and then to the middle class, and then to the lower class. It trickles down. Wow. And so what you see is this growth of lack of saving where everybody is trying to spend like they're rich, to signal that they're rich, but they're not.
And it's harder and harder to save these days. If you put your money into a savings account, what are you getting back on interest? Like less than 1%, right?
Right, exactly.
And that means, all right, then my option might be to put my money in investments, go to the stock market. But if I don't know what I'm doing, if I have to pay fees and I make the wrong choice, I mean, it's getting harder and harder to save. So is that a deterrent for people, do you think?
That's right. I've already blamed some American households. So now I think I should blame someone that isn't an American household. How about US policy? In the last few decades, the US private sector has moved from retirement plans that were called defined benefit. You knew what you were going to get when you retired, to defined contribution. You only knew what you were putting in and then maybe what was being matched. So this is the classic 401k. But 401k doesn't provide the same sort of retirement security that a defined benefit retirement plan has. And 401ks, particularly in the US, are leaky. For every $1 contributed to a 401k, 40 cents, 40% flows out in the form of premature withdrawals. Some people call this, flexibility. The 401k
you take the money out to buy a house,
take it out whenever you want. But in the long run, this really is unfunding one's retirement. And this is a feature, not a bug of the 401k. We make it easy to take money out. We make it easy for middle-class people, or have made it easy, particularly in the last 15 years before the crash, for middle-income people to buy a house that was slightly out of their range, for lower-income people to do the same. So the US is a country that, as a matter of national policy, has made it really, really easy for people to spend a lot of money. And we don't have the same sort of forced savings programs that other countries have.
Well, we're going to link you to the story. It's called Why Don't Americans Save More Money at hereandnow.org. Derek Thompson is a senior editor at The Atlantic. Thanks as always for talking to us.
Thank you.
All right, so it's no wonder why so many Americans are in debt, because they can't save money. And as the cost of living goes up, as incomes tend to stagnate, as this aspirational lifestyle that we all want to achieve becomes more and more tempting, it's no wonder that Americans really struggled with debt problems. All right, so what do? You got to take a closer look at your spending. It's like going on a diet. You want to see what you're taking in. You want to, even the smallest snack, of course, represents something that you want to account for. So, are you buying your $5 latte every morning? Okay, are you making small purchases that may seem inconsequential individually, but collectively can be something significant? You want to call, if things are really bad, you want to call your creditors. A lot of creditors, of course, would rather get back something than nothing. So maybe a creditor might be interested in renegotiating the terms of your debt, okay, to lengthen the amount of time you have to repay or to shrink the payments. This idea of debt snowball, where you address one debt at a time. You take a look at the size of the amount of money that you owe. You have a small debt, a larger debt, and an even greater debt, and so you attempt to pay off your smallest debt first, and that begins hopefully a momentum that will lead to the snowball of repayment growing and growing and growing. And then, of course, there's the option of seeking professional help. And professional help comes in the form of credit counseling. And this is the National Federal Organization of Credit Counselors that you can see the map here. So there are credit counselors all over the place, unless, of course, you live in southern Idaho. Credit counselors are trained to take a macro look, a holistic look at your finances and help you reduce your debt and use your credit responsibly. And a counselor may be able to help you develop a plan to break out of your paycheck to paycheck cycle, which so many Americans are in this paycheck to paycheck cycle that inevitably chains you to debt for what seems to be your life. So that ends my presentation. Hopefully you found the information helpful, and that you can then convey this to your kids. I'm going to stop sharing here, and I will say thank you very much.